Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome back to Tax Smarts Unlocked. I'm David Robson, your resident tax planner and translator of IRS ES. Today we're tackling tax loopholes. Some hear that word and picture smoke-filled rooms. I hear Congress saying, please invest, hire, and document. Most loopholes are intentional incentives, not tricks. The line between smart and sketchy is simple: economic substance, business purpose, and documentation. If your plan makes sense without the tax result and you can prove it with contemporaneous records, you're likely on solid ground. If a promoter promises outsized deductions with circular money flows and little real activity, walk away. In this episode, I'll cover entity choice, S corporation pay, accountable plans, QBI, depreciation, home office, and the Augusta rule, vehicles, meals and travel, health insurance, HSAs, retirement, R&D credits, real estate and SALT workarounds, small taxpayer accounting relief, timing moves, audit readiness, and red flags, plus case studies you can adapt. Start with the foundation. Entity choice. Sole proprietorships are simple but expose every dollar of net profit to self-employment tax. An LLC is a legal wrapper that can be taxed as a sole prop, partnership, S-corp, or C-corp. S-corporations may reduce self-employment tax by splitting owner pay between W-2 wages and distributions, but you must run real payroll and keep minutes. Partnerships shine for multiple owners and flexible allocations. Partners usually owe self-employment tax on active income. C corporations offer flat rates and robust fringe benefits, yet can trigger double taxation. If you go S-corp, reasonable compensation is your guardrail. Benchmark wages using role, geography, time spent, duties, and profitability. Document a memo annually. Too low invites audit, too high erases the advantage. Revisit your entity each year as profits, owners, and exit plans evolve. Next, put an accountable plan in place. With a simple written policy, your company can reimburse business expenses tax-free when employees substantiate and return any excess advances. Think a business share of home internet and phone, mileage, professional dues, education, and travel. Without the plan, reimbursements can become taxable wages. For S-corp owners, this often moves costs from after-tax dollars into the business, sometimes improving qualified business income. Speaking of QBI under Section 199A, it can deliver a deduction of up to 20% on eligible pass-through profits, subject to thresholds, specified service trade limits, and a W-2 wages and UBIA property test. Planning levers include setting defensible but not inflated S-corp wages, timing equipment that boosts UBA, using aggregation when allowed, and avoiding incompatible income. Model scenarios before year-end so you don't accidentally phase yourself out. Depreciation is another lever. Section 179 expensing lets you write off qualifying equipment up to an annual limit, but it cannot create or deepen a taxable loss beyond business income. Bonus depreciation applies automatically to eligible property and is phasing down under current law. Strategy matters. Map deductions to profits to smooth income and preserve QBI. Track listed property rules for passenger autos. Business use must exceed 50%, and logs are essential. Home office deductions require regular, exclusive business use. Choose the simplified square foot rate or actual expenses allocated by business percentage. If your home office is your principal place of business, miles from home to clients become business travel. The Augusta rule, Section 280AG, allows your company to rent your home up to 14 days per year. Document fair market rent, real business purpose, and invoice and approval minutes. Vehicle deductions come in two flavors, standard mileage or actual expenses. Choose the larger, but remember you must start with standard in year one if you want the option to switch later for that vehicle. Keep a contemporaneous log noting date, destination, business purpose, and miles. Branding on the door does not replace a log. If business use is consistently high, a dedicated business vehicle can simplify accounting. Meals are generally 50% deductible when ordinary, necessary, and not lavish. Company parties and certain employer-provided events can be 100% under current rules. Entertainment is non-deductible, but but a meal during a bona fide business discussion is fine. Document who, what, and why. Business travel must be primarily for business, require sleep or rest, and be reasonable in cost. Per diem rates simplify record keeping. Mixing in personal days is okay if business remains the primary purpose. Health insurance and retirement plans deliver deductions with long-term benefits. The self-employed health insurance deduction allows you to deduct premiums above the line, limited by profit. For S-Corp owners over 2%, have the company pay or reimburse premiums. Include them on the W-2, then claim the deduction on your return. Done correctly, it avoids payroll tax. Pair coverage with a health savings account if you use a high-deductible plan. HSAs enjoy deductible contributions, tax-free growth, and tax-free qualified withdrawals. On retirement, a solo 401k often beats a SEP for moderate to high profits because you get employee deferrals plus employer profit sharing. Adding a working spouse can multiply savings. Simple IRAs are easy but have lower limits. For very high stable income, a cash balance plan layered with a 401k can supercharge deductions. Just commit to actuarial funding and compliance. The R&D credit isn't just for labs. If you're developing or improving products, processes, software, or formulas, you may qualify. Startups can elect to use the credit against employer Social Security payroll taxes up to an annual cap, delivering cash flow relief before profitability. Track projects, hypotheses, testing, and costs for eligible wages, supplies, and contractor research. Smaller filers may qualify for the small business taxpayer exception. Under the current gross receipts threshold, you can use the cash method, avoid unicap, and simplify inventory. Great for bookkeeping and tax timing. Speaking of timing, prepay reasonable expenses, defer income when aligned with reality, and avoid circular same-day steps that could trigger the step transaction doctrine. Always document business purpose and economic substance so your timing holds up in exam. If you own your building or other commercial property, consider cost segregation to reclassify certain components into shorter life assets and accelerate depreciation. It's a powerful timing tool that increases current deductions but may raise depreciation, recapture on sale. Model both the upfront savings and the exit. Know your passive activity rules. If rentals are passive, losses might be suspended unless you qualify as a real estate professional or make a valid grouping election with your operating business. On state taxes, many states offer pass-through entity tax elections for partnerships and S-Corp. The entity pays the state tax and deducts it, effectively bypassing the individual SALT cap for eligible owners. Each state is different. Confirm eligibility, owner consents, rates, and especially estimated payment deadlines. Missed dates can forfeit the benefit for the year. Let's talk guardrails. Avoid syndicated conservation easements promising massive 4x deductions, micro-captive insurance without real risk distribution, exotic trust arrangements that zero out tax, and aggressive ERC mills filing claims without meeting the gross receipts or suspension tests. If it sounds effortless and extraordinary, it's likely non-compliant. Build an audit-ready culture instead. Contemporaneous mileage and time logs, scanned receipts, clear notes on who, what, when, where, and why, and written policies for accountable plans and travel. Close your books monthly. On estimated taxes, use safe harbors to avoid penalties, generally 100% of last year's total tax, 110% for higher incomes, or 90% of this year. Split across quarterly due dates. Coordinate federal, state, PTT, and payroll deposits. Cash flow these payments alongside retirement contributions so deductions and liquidity stay in balance. When should you bring in a pro? Earlier than you think. Call before you choose or change entities. Set S-Corp wages. Adopt a retirement plan. Sign a lease or purchase property. Run cost segregation. Elect a state PTET. Or claim the R&D credit. A 1-hour modeling session can prevent a 5-figure mistake. Leverage digital tools to make collaboration easy. Cloud accounting with bank feeds, rule-based categorization, receipt capture that ties images to transactions, payroll that e-files W-2s and 1099s, and encrypted document portals. Good systems create better data, which enables better advice. Proactive planning usually pays for itself through reduced tax, penalties avoided, cleaner books, and time you get back to build the business. A few quick wins from the field. An S-Corp designer with rising profits. We documented a mid-market reasonable salary, adopted an accountable plan for home internet, phone, and mileage, and preserved QBI. A pre-revenue software startup. We mapped engineering sprints to the R&D 4-part test and used the credit to offset payroll taxes, extending runway. A contractor eyeing big equipment. We blended Section 179 and bonus to smooth income and keep the QBI deduction. A professional partnership in a high-tax state. The PTT election converted non-deductible individual SALT into a deductible entity expense coordinated with estimated payments. That's our tour of smart, compliant loopholes. We covered entities and comp, accountable plans, QBI, depreciation, home office and Augusta, vehicles, meals and travel, benefits and retirement, R&D, real estate and SALT workarounds, small taxpayer relief, timing, and audit readiness. I'm David Robson. This is Tax Smarts Unlocked. Plan early, document well, and keep more of your money today.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.